There are many different types of stock trading styles for you to choose from, based on how much capital you have available, your trading style and goals, as well as your knowledge and experience. If you are considering leverage stock trading, margin-based derivatives are usually the best because of the risk factor. Stock futures dealing has a similar operating style to that of margin-based derivatives, but with higher risks. It is sometimes difficult to see if these potential forms of investing are worth it or not when you look closely in some ways. So, what makes them different? Luckily for you, Fortune Fastlaner, we prepared everything you need to know about the difference between crypto margin trading and futures trading. Remember that while the first step is completing any of these fantastic courses, the second and possibly more important step is taking action, even if it's an imperfect action. Buying and selling cryptocurrencies with the expectation of profits is different from futures trading. With margin trading, you borrow money from a broker to purchase more crypto or sell crypto that you do not have. Contracts with futures are used to control long or short positions on a specific date by listing the value of a collateral as part of the contract. Continuous futures also exist without a specific delivery date, but come with daily fees. When trading crypto, it is important to understand the ins and outs of margin and futures trading and how these operate, so you can make a smart decision on which strategy to use for your portfolio. Having a clear understanding of the differences and similarities between margin and futures options will help you choose which format of investment suits you best. But first, what is margin trading and futures trading? Margin trading is the process of obtaining stocks or other assets from a brokerage to execute a transaction. Through this mechanism, leverage can be used to amplify gains and losses, providing significant additional trading opportunities when compared with traditional methods. A margin account is a loan account that you open with a brokerage. To maintain the account, you must provide collateral to offset part of your credit risk with the third party. This collateral is officially known as a margin, which makes sense because it is technically the margin between your credit ceiling and your threshold. In order for Trader A to open an account with Brokerage B and be able to borrow trader stock, Brokerage B would need to know how much money Trader A had in total. To make this happen, the margin trade would need to go through first. This ensures that only the sum of Trader A's money is put at risk when he invests with Brokerage B and not all the trader's net worth. Brokerage B is able to borrow $10,000 from Trader A under the condition of taking a $5,000 loan in turn. The margin is important because it is a financial commitment Brokerage B can use in the event Trader A makes heavy losses. On the other hand, futures trading is a kind of derivatives trading. This means that assets are not being directly traded, but rather contracts that derive their value from assets. Futures trading deals with the purchase and sale of certain financial contracts, requiring both parties to buy and sell the underlying asset at an agreed time. For investors, a futures contract is a contract that stipulates the obligation to deliver an asset at a predetermined price on a particular date. Futures trading is typically done by companies and individuals for predictions about what prices might be in the future. This helps you protect against inflation because the contract automatically fixes the pricing for a set period of time. Sometimes, traders can use this fluctuation to make money by betting huge sums of money on it. With these types of variations, it's difficult to make a good amount of profit from trading except if someone bets a lot of money on buying the contract. With futures trading, there are two concepts put into play. A margin is similar to how it works on a brokerage account, and leverage is how much profit or loss can be made depending on the market. For this reason, brokers must be specific about which market they want to trade in because opening an account with the wrong broker could lead to an empty future. A common mistake that people make is that they think the two traders are strikingly similar, leading them to make a costly error. Margin trading and futures trading have many similarities in terms of how they are often defined and used, which can lead to one confusing the other. Before we go to their differences, let us talk about their similarities first. Margin versus future. Margin versus futures involve many similarities, but there are also differences. Analyzing both is a good idea to know which type of account to have and what risks it is best for you to handle. Maybe you want to open a margin account or a futures one. Your goal could be to have one of each type or neither of the types. Futures and margin trading both can offer some advantages to traders in the cryptocurrency markets. One of the benefits is that you can make bigger trades than spot trading or the cash market. The futures market and a margin account simply go about it differently. Both methods might entice prospective crypto traders with the possibility of big quick gains, but losses can be just as dramatic too. While cryptocurrencies have many advantages, they often have much more volatile nature than stock market indexes. That is to say, if you trade with leverage or options, be prepared for high movements in your profits and losses. Now, let's talk about their differences. As we said earlier, understanding the differences between trading with margin and futures could help determine the best investing strategy for your risk tolerance and return objectives. For starters, futures trading requires a good faith deposit to access contracts with quarterly maturity. A crypto margin account lets you leverage the spot market. The futures market might require that you pay closer attention to liquidity, that is, how easily you can trade while still receiving a competitive price. With a crypto margin account, liquidity is generally not a problem in the spot market. That is because the future time frame isn't limited once you have an expiration date. However, it is more important to consider how long you would like to hold onto a coin. With futures, on the other hand, expiration dates set a limit on how long you can hold a position, but perpetual futures allow you to bypass this. It's important to consider the premium over the spot price you are paying or being paid. Additionally, trading on an unregulated platform could result in liquidity failures and liquidation. To understand this better, let's discuss their differences one by one. Number 1. Trading pairs. Margin trading offers access to exotic pairs. Traditionally, with margin trading, an exotic pair involves two global currencies paired together, like AUD and CHF. With traditional margin trading, the trader is betting on the relative performance of the two global currencies. When conducting transactions in a pair of cryptocurrencies, like buying or selling Bitcoin or Ethereum, the market order is typically placed by the user. This is effectively speculating on their relative performance. There are often many verticals and streams in cryptocurrency trading, but these types of cryptos are mostly useless and impractical because they lack liquidity in the market. Futures contracts use a cryptocurrency as collateral and have a fixed deposit withdrawal structure with one specific cryptocurrency. Number 2. Daily interest payments. When trading with margin or perpetual futures contract on Binance, it is important to consider the funding fees and interest payments. Daily expenses are taken into account for all trades made on Binance. Daily interest expenses can add up quickly and lead to high costs when holding a position over a long period of time. With quarterly futures contracts, you can avoid these charges entirely. Binance offers futures contracts on its platform that don't incur daily fees, making this the ideal product for long-term holders with multiple positions. Number 3. Expiration. As previously mentioned, margin trades rely on careful attention to trade. This is because they may be traded into perpetuity or without end. There's no set date on which the trader closes the trade. With futures contracts, and more specifically quarterly future contracts, traders must adhere to the time frame allotted in the contract. Number 4. Prices. Cryptocurrency trading pairs and futures prices are similar to the spot market. However, futures prices may be different due to the changes in supply and demand during the interim period before they are delivered. The futures price is based on the current spot price, plus the cost of carrying during this interim period, also known as the basis. This gives arbitrage opportunities between margin and futures contracts. For example, if the funding rate on a futures contract is negative, traders can take advantage of a price discrepancy by going short on margin and long on the perpetual futures contract. Number 5. Leverage. From the elaborations on margin and futures trading, we can see that they are both places where leverage makes traders' lives easier. However, a significant difference between margin and futures trading is the extent of leverage available for traders in each category. The margin trading markets offer up to 10 times leverage, which is 10 times that of normal investments. You can use this extra cash to drive your returns even farther by trading futures markets. Number 6. Asset class. Margin trading is when traders buy security that they can participate in the value of. This shares similarities with spot trading. Options are often considered derivative investment, which means it is only worth something if and when the underlying security value changes. Futures trading is largely geared towards derivatives because investors take bets on future price of an asset rather than owning it and taking part in its value. Number 7. Risk. The risks associated with futures trading are much greater than that of margin trading. With a higher leverage, traders can lose huge amounts of money because they have too much credit and potential to trade on. Question is, which should you use? Margin and futures trading are both used for the same purpose, investing in a trade rather than making it on your own. One of the main considerations between margin and futures is how experienced you are as an investor, and if you have the adequate funds available to invest. Now, how can you invest and trade crypto with SoFi? Using advanced trading methods, including but not limited to margin trading and future contracts, allows you to control investments more easily in the world of cryptocurrencies. These are advantages and disadvantages to both. Crypto margin trading lets you trade the spot market risk-free, while crypto futures offer leverage. However, using cryptocurrencies as collateral for large future positions set up in advance comes with its own risks. With SoFi, you can invest in cryptocurrencies while assuring the safety of your assets. You may still be confused. Are margin trading and futures the same? Margin trading and futures trading are two different trading techniques. It's key to understand both approaches before using them because they are considered advanced. Margin accounts typically involve traders opening crypto positions with borrowed money. You can control more capital with your portfolio, which allows you to leverage positions. You can experience amplified gains and losses with margin trading, so it is riskier than trading without leverage. Futures contract agreements are set for a certain price to be determined at times in the future. This either works as a long-term futures contract or short-term futures, and both of these types of contracts can be traded on crypto exchanges. Do you need a margin to trade futures? A margin refers to a good faith deposit to use as a collateral, with which you can use open futures positions with no need to borrow anything. However, future traders might owe funding rate fees when they own perpetual futures. The collateral taken in futures account is considered your maintenance margin, a minimum amount of equity needed to continue trading. What are futures contracts and how do they work? Now, margin traders participate in crypto spot market while future traders show interest in asset prices to be delivered at a later date. Crypto futures markets are primarily targeted towards speculators. Participants speculate on how high the price of a given coin will go. With margin as collateral, you can open positions worth up to 250 times of your investment. Margin trading allows to a high degree of leverage, but it also comes with risks and costs in the event that you want to close your position. Crypto futures are more likely to trade at a large premium to the spot market, and it will likely take some time to close on open futures position at a competitive price. Future contracts on Binance Futures are intuitively designed and easy to use. A key benefit of future contracts, particularly the USDS margin contracts, is that they allow you to easily calculate your returns in fiat. For example, when you make a profit of 500 USDT, you can roughly assume that it is worth about $500, with crypto guarantees. Future brokers don't need to worry about borrowing and repaying loans to fund their positions. For those trading cryptos, everything is easy and straightforward with the new crypto guarantee. Margin trading offers some key advantages as well. With margin trading, the trader has more freedom to choose when and where to implement their trading strategy. For instance, if a trader predicts that Ethereum will outperform Cardano in the long term, then it makes sense to short ADA or ETH with leverage. Using futures contracts, you can purchase or sell specific cryptocurrencies without directly owning them. Buying with margins allows you to buy or sell outright, which is much more efficient than using a traditional order type. So while margin trading pairs may look like they are the same in some ways, they're definitely distinctive and not marginal. While they share some similarities like leverage and degree of risk, they also agree that it is rewarding yet risky nonetheless. With a little effort, you can learn to take advantage of this driving cultural shift by beginning with your margins ready for action. Both types of trading can lead to immense success and should be taken as seriously as if they pose the risk of a big loss. If you're just getting involved in trading, spend time learning how the market on your chosen platform works and what it feels like to lose money or earn profits. That's it for this video, Fortune Fastlaner. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you on the next one.